big story here at the open is Nvidia's surge above 3 trillion market cap and bringing its year-to-date gains to just about 150%. So what does this tell us, more broadly speaking, about the equity market and where we're headed from here? We want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to see you here. So when we talk about Nvidia's surge here, it really has made, I guess my takeaway is the fact that it's made the S&P's rally since the start of the year even more concentrated. Should we be viewing this at all as a risk at this point?
Hey, thanks for having me on. So I understand why people are questioning that. Certainly when we speak to clients, that is a key question that people are having. There is some vulnerability inevitably when you do have the index being so driven by one or a handful of stocks. But I think the good news that we've been seeing in the last couple of months, and certainly in the last earnings season, is actually you've seen a lot of the positive economic news spreading not just to these mega cap tech stocks, but you're actually seeing earnings growth across a variety of sectors. If that were to continue, and certainly in this kind of economic environment that we're seeing, where you're seeing solid growth and continued momentum, that actually that broadening out should continue. So there is vulnerability, but certainly the signs are quite positive at this point.
Yeah, and it certainly seems like for the companies that are looking out to the quarters ahead, based on some FactSet data, they're also increasing some of their earnings estimates as well here. So what is going to be kind of the key for actually meeting some of these targets that companies have set forth? Because it can't all be driven by AI, right?
So AI will inevitably be a key driver for a number of sectors, and not, of course, just this quarter, but we're looking at over a number of years as well. But as you said, when we're looking at earnings expectations for the remainder of 2024 and into 2025, the key thing that we're looking for is this continuation in economic growth. So we're already seeing activity actually downshift slightly, but we're nowhere close to what should be recession territory. And against that backdrop, the earnings outlook should be quite positive, and it should really be delivered. So that's the thing that we're looking out for. Fed expectations, of course, they do come into the equation, but actually more and more, the story is really about growth rather than what the Federal Reserve is about to do.
Seema, when you take a look at where we are right now within the market, especially those handful of mega cap names, the current valuations, are valuations at all stretched at this point?
Well, look, if you were to look across, study at those mega cap tech names, you would probably be frightened. You look at those valuations and say, wow, they are very, very lofty. On those specific ones, they are stretched, but it's not really a comparison to the dot-com bubble because companies actually have something to deliver. So there is a very significant difference between now and the dot-com. Now, if you were to look across the rest of the market, actually the valuations do not look that stretched. There's a lot of opportunities across a number of other sectors, other types of companies. We're actually, for investors today, that's what we're saying. We're recommending look at the other opportunities out there because valuations in some segments of the market are stretched, but actually across a wide variety of sectors in the US and internationally, there are some really, really attractive opportunities, which are also combining with improving fundamentals as well.
Seema, you just mentioned what the Fed may do. And as I'm taking a look at the CME Fed Watch tool, it seems like at their meeting next week, no change is expected. Even as I'm taking a look at the probabilities for July, where we've had some economists come on and say, hey, it's not off the table. Well, it seems like it's more on the table that they might not do anything as that probability has moved higher for them to stay the same in July. But then all the focus kind of shift towards September there. What is your estimation for, even as we get a trove of jobs data this week ahead of their meeting next week, what their evaluation of the employment situation will really kind of hand in terms of their conversation and the tenor of their next meeting as they're trying to get back towards that 2% inflation goal?
Yeah, so certainly for us, the July meeting is not really on the table. We're not anticipating a rate cut as soon as that. By the time you get to September, they've hopefully had a number of months worth of data, which should, at that point, start to show a clearer sign that this deceleration in inflation has resumed. And also that the labour market, whilst it's still fairly solid, that there are a few cracks and some weakening going on. So at this point in time, each bit of data that's coming through, particularly in the labour market and on the inflation side, are extremely important. We need to see a run of weaker data on inflation and the labour market for the Fed to be confident enough to cut rates in September. And we don't want to over-exaggerate this point, but of course, making a decision to cut rates ahead of the presidential election probably means that they need to be very, very convinced. They need to have very clear evidence that the economy requires those cuts. So if there is any kind of doubt, any hotter than expected inflation data, then unfortunately that does probably push out that likely date through to the end of the year, if not 2025.
Seema, let's talk about what's going on around the world today. We have the ECB cutting rates, the first time that they've cut rates since 2019. My question to you is, in terms of what this signals for an investment opportunity, when you stack European equities versus what we're seeing here in the U.S., is there reason now to be a bit more bullish on the trajectory of European equities?
Yeah, so, investors would have become accustomed to the US really outperforming a number of markets for a very, very long period. Now we're actually seeing some really interesting cyclical opportunities outside the US. You mentioned Europe. Over there are more attractive valuation. Stocks are certainly considerably cheaper than what you're seeing in the US. But on top of that, you're seeing a cyclical economic upturn where the data that is coming in is surprising to the upside. That is very different to what you're seeing in the US, where the data is now trending down. And then central banks, I think the question mark around when the Fed is going to cut still remains. Whereas for the ECB, of course, they have cut rates today, and there's a fair certainty that there will be further cuts to come. So those three factors together really do suggest that European equities are in for maybe a period of outperformance. I wouldn't say it particularly sustained over a number of years, but at least for the near future, they should continue to outperform. And then even if you start looking towards Asia, where Japan has had a strong performance, but we're expecting that to continue. So I do think this is an opportune time for investors to look internationally, not just at the US at this point.
Seema Shah, Principal Asset Management Chief Global Strategist. Seema, thanks so much for taking the time here today just after the market open.
Thank you.